Hi guys, this is Teacher Party. Welcome to my YouTube channel, Accounting with Teacher Party. Please like, subscribe, share, call your neighbors, friends. Let's get distinctions in this subject. And I believe that with all my heart. Guys, what I'm sharing with you, it's not my work. This slide is not my work. This is from the Western Cape government, the Department of Education, as you can see. So this is not my work, but it is very good theory for asset management in grade 12. So topic, fixed assets, tangible assets. So they refer to what you've already done in the previous grades. That is concepts and all. And they've got revision packs. You just click here and it takes you to your revision pack. How amazing. So guys, don't say I don't tell you nice things. Let's go back. Okay, so fixed assets can feature in paper 1, reporting financial information, or in paper 2, information relevant to internal control purposes. So what are tangible assets? Tangible assets of the business are not intended for resale, but are acquired for generating income for the business. Example, land and buildings, equipment and vehicles. These assets are shown in the balance sheet at their book value or carrying value. That is historic price less accumulated depreciation. So depreciation, fixed assets except land lose value due to usage, wear and tear. Business policy will show how the values are to reduce each year. The useful life of each asset will be considered to determine the residual value. The two methods, there's a straight line method, that is the fixed installment, the percentage of the cost or the years, and then there's the diminishing balance, which is you're calculating depreciation at carrying value. And you must always prorata, meaning you must always apply the period when you calculate accumulated depreciation. So remember, guys, I said this is not my slide. This is by the Western Cape Department of Education. So I'm just reading it out to you and explaining what they mean. So this is not my work. I'm putting a disclaimer. So in what instance then would a business sell assets? When they've reached their end of term, they're not productive anymore in terms of generating income, then they would dispose or write off assets. So the asset disposal account, you've done it in grade 11. On the debit side, you put the cost price, the historic cost price of the asset. On the credit side, you put the accumulation, the accumulated depreciation of the asset up until the date of sale. So which means it's the old depreciation plus this year's, the current year's depreciation. And then depending whether this was sold on cash or credit, then you will balance to whatever, okay, depending on this, if it's sold cash or credit, you will write that on the credit side. So depending on which side is bigger than the other, you'll balance to a profit on sale of an asset if you're balancing on the debit side. If you're balancing on the credit side, it's loss on sale of an asset. So fixed asset note to the statement of financial position, the balance sheet provides a detailed breakdown of the business's fixed assets. It should correlate to the asset register. The total carrying value at the end of the year is reflected in the balance sheet under non-current assets. Example 2, understanding the fixed asset note. Land, buildings, equipment, total. So it will be the different asset classes that the business has. And you start with the carrying value at the beginning of the year, the cost and the accumulated depreciation at the beginning of the financial year. Then you record the movements, which is your additions at cost, your disposals at carrying value, and your depreciation. Your depreciation must take into consideration the disposal. So the depreciation for the disposal must be adjusted in the depreciation amount for the year. Then the carrying value at the end of the year, it should be the total book value of all the assets available at the end of the year. So you've done that in grade 11 already. So specific topics where assets are integrated. Income statement is the calculation of depreciation, the asset disposal, and then balance sheet is the fixed asset note, the asset disposal, meaning the profit or loss on asset disposal. Then cash flow, the effects on investment activities, paper 2, cost accounting, factory, property, plant, equipment, and then budgeting, leasing, and buying decisions. Okay, internal controls of fixed assets. This question, guys, usually comes out. Typical internal control measures that will ensure effective control of assets. And it says, make sure you briefly explain each measure. Comments in the exam can be based on these. It must still be relevant to the question. 1, asset registers must be updated regularly. So preferable automated asset registers. Records must be kept of all assets. Fixed assets are procured with proper authorization. Fixed assets are not written off and disposed without proper authorization. Fiscal counting of assets, rotation of employees, division of duties. So GAAP principles applicable to fixed assets: the historic cost, assets are valued at original cost, the matching principle, the depreciation for profit or loss on sale of assets, the concept of materiality. Okay, so here you are given an activity. So it's activities to solve. So guys, let's jump to the question papers and do the fixed assets practice. Bye, share, subscribe, and download this. You've seen the HTTP that I've applied to get to this slide. Just type asset management PDF. It will give you the Western Cape government. Bye, guys.